10.
Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam. The headlines at this hour. Benchmark indices swing between gains and losses as investor sentiment remains subdued. Axis Bank falls more than 1% after the lender says it has an exposure of 200 crores in Nirav Modi and Mehul Choksi's firm. ICICI Bank is one of the top 50 losers despite claiming to have no exposure. The PNB fraud may enforce the government to reevaluate its 2 lakh crore bank recapitalization plan. And Donald Trump's top economic advisor Gary Cohn steps down even as the president says he's not scared of a trade war. We'll get to that in a moment, but let's talk about the markets first. Neeraj is here as always to tell us what's going on Dalal Street today. Neeraj.
Well, frankly, it's difficult to pick and choose, Harsha. It's across the board. Banks which have come out and clarified that they do not have any kind of exposure to this Nirav Modi case are also getting punished. And the reason I bring that up is because yesterday's fall, or the start of this 5th or the 6th day, was led by banks because of this news flow around how private banks were summoned by the SFIO. But in today's session, despite clarifications, that hasn't helped. The fact that today the world markets are not as strong and buoyant as was the trade yesterday might also be weighing in. And if you just take a look at what the Asian markets have done or what the Dow futures are doing, they obviously aren't as rosy as what the picture yesterday was. Yesterday there was firm green and yet we fell. So today, yes, the global market support is also not there. But frankly, the last few days we made a habit of doing it on our own. So SBI, ICICI, Axis, across the board, SBI in particular, has bore the brunt of selling pressure in today's session. Select outperformances by 1 or 2 names, but that notwithstanding, all marketing companies have reversed gains as well. And you know, the pockets of weak names in a certain group is pulling those groups down. So yesterday, Harsha, we saw evidence of the Adani Group stocks coming off, and in today's session too, if you look at almost all of the Adani Group stocks, they have come off in the session today. But the JP Group stocks as well have come off in a hurry. And typically when these weaker hands starts to unravel 9-10% is when you know that the market is now starting to get worried about what the near term could look like. So 6 days of losses, yes, I agree, it's fairly steep, but almost anybody that you speak to is not saying that this is the end and this is the bottom from where we'll bounce back. We've broken key moving averages. There is a likelihood, an outside chance that this may not really stop in a hurry.
But if you look at it broadly, we've performed a lot worse than our global peers, haven't we?
Yeah, so actually, you know, and the next piece that I do, we'll talk about that as well, because while in the last few weeks, we would have, yes, gone beyond what the global peers have done, calendar year to date, we're pretty much in line with what the others have done, to be honest. So, you know, let's talk about that piece actually, because while we may have performed a lot worse than the others, just try to analyze what the pain points for the market could be, as Harsha, and analyzing it on the basis of what the last few weeks have thrown at us. So firstly, I borrowed a chart from Morgan Stanley's note, which came out on February 26th, I must admit. But they made at this point that if you look at the market cap to GDP, ex Sensex and with the Sensex, ex Sensex would naturally mean the broader markets, and that valuation parameter, no, the first chart, that valuation parameter, the gray line is the markets ex Sensex, the blue line is with the Sensex, and you can see the differential in valuations. The markets ex Sensex as of Feb 26 looked much more expensive than the markets with Sensex as a percent of GDP, and therefore the call was that the broader markets correction would be more steep than the large caps, and I think we've seen evidence of that. 2018 YTD, starting from the 1st of Jan and until about 25th, 23rd, 6th of Jan, we did well. 29th of Jan onwards, we started collapsing for the large caps, mid caps slightly earlier. But look at this, the Nifty is corrected about 3.5, Nifty Bank 5.5. It's almost 10%, so almost double of what the Nifty Bank has done, and 3 times what the Nifty has done is the kind of correction that the mid caps and the small caps have already seen. But to question of whether India is negating all that's happening in the world and falling on its own, I think that thesis gets corrected by this particular chart as well. Now, if you just look at what the Nifty has done vis-a-vis all the other markets and ignore the Bovespa because that's had the gains of its own, almost all the other markets have corrected. Yes, now by virtue of this fall, the Nifty and the Kospi are amongst the worst performing markets to date. But the others, it's not that really they have outperformed in a meaningful way. 2-3-4% kind of an outperformance, probably par for the course. As I said, Kospi's actually performed worse than the Nifty too. And the last, and then you think about the reasons thereof. Everybody talks about how US is the epicenter of all of it. And, I was reading the absolute return letter yesterday. They brought out 2 points that, commonly known, but just highlighting that the fear of a serious bout of inflation and whether the Fed itself is behind the curve, really behind the curve. Multiple people have said that the Fed will be surprised at the pace at which it will have to hike rates as well. The debate is up in the air, really. Nobody knows what the outcome will be, but these are the fears thereof. And then when such fears plague the US markets, I think that famous saying comes to the fore, right? That correlations go to 1 before you can count to 10. So if the US markets or the mother market is going to come off, there is no way that we are going to be left alone or singled out. So simple point being, we will correct if the global markets are correcting as well. And while the valuations may be still just about par, and they've stayed that way for the last 3 or 4 years, and you can use multiple parameters to figure out if you are above standard deviation or below standard deviation or just right there. Morgan Stanley believes that the valuations were at par. But the last few days of correction have shown, Harsha, that we're not spared. Just look at the one last chart, and that's from Jan 29th, wherein we first started that big fall for the large caps. Rate sensitives have been clobbered. State Bank of India, ICICI, Axis, Bajaj Auto, Tata Motors, Yes Bank, a clutch of these rate sensitives which are being clobbered out of shape. And, and we haven't had the fall coming into the heavyweights. The HDFC Twins, Reliance Industries, and a couple of other, those stocks are missing from the list of the top losers. And yet we've already corrected so much more than what some of the others have.
Neeraj, thanks for putting that in perspective. But, the big story is really what's going on in the United States. Donald Trump has lost another lieutenant this time because he's decided to trigger a global trade war. Gary Cohn, Trump's top economic advisor, has decided to resign as the administration prepares to impose steep tariff on steel and aluminum imports. Cohn has been obviously against this move. Bloomberg's Marty Schenker discussed this political and the business implications of Cohn's resignation earlier today. Listen to this piece of that conversation.
We heard this was coming. Actually, we've heard this was coming for months, and it hadn't happened. Now it has. What do you make of it?
Well, what I make of it is we reported a story this morning that said that if Donald Trump was going to impose these tariffs, which he was strongly against, that he would resign. Does this signal, in fact, that Donald Trump is not going to change his mind and impose the steel and aluminum tariffs? If you listen to Donald Trump today, he said he would. So out goes his chief economic advisor. If you're the chief economic advisor and the person you're advising is not taking your advice, it's time to go.
Gary Cohn is a Democrat. He contributed to Hillary Clinton's campaign. He was sort of an unlikely candidate for this job in the first place. But he took it.
He took it.
What do you make of it coming to an end so quickly? Though, I guess supposedly in the context of some of these other positions, maybe it's not so quick at all. This is an administration that has had an incredible amount of turnover.
Yeah, 1 year in the Trump administration is like 4 years in any other one. So, and given it, look, it was not a normal work environment in terms of presidential administrations. He did orchestrate the tax bill. He said that was the reason he was there, to try and get that through. I could take some issue with it is truly tax reform, and there are a lot of people who are very critical of that tax package. So it'll be very interesting to see who replaces Gary Cohn in this administration, and what is he going to be part, or she? Are they going to be the free trade wing, or are they going to be the protectionist wing?
What do you suspect?
I suspect it will be more towards the protectionist wing.
And what does that mean for business? It
means, well, look, business. This has been a pro-business administration. The issue of being protectionist has not been tremendously fulfilled by this Trump administration so far. The tariffs are the strongest effort he's taken on that front. Is this Donald Trump doubling down on his rhetoric? It may very well be, and that will not be good for business, as the markets have shown.
All right, that was Marty Schenker of Bloomberg News. Let's move on. Now, the trajectory of U.S. trade policy is clearly troubling. Reports that Trump administration is considering a clampdown on Chinese investments in the United States and imposing tariff on a broad range of imports could be a game changer for global growth. On the other hand, comparing the current situation to the trade wars that deepened the Great Depression may be a little overdone, says Tom Orlik from Bloomberg Economics. He now joins us from our studios in Beijing. Tom, thanks so much for joining in. You know, this report of the United States trying to clamp down on Chinese imports, how serious is this, and what do you think are the ramifications?
I think at this point we have to start taking these rumors coming out of DC pretty seriously. Steel tariffs, aluminum tariffs, on their own, these are not significant. These are not going to move the dial for China. China just doesn't export enough metal for those tariffs to have a big impact on GDP or the aggregate trade numbers. What would be much more concerning would be if the Trump administration moved with a broad tariff which affected consumer goods like textiles, like shoes, like home electronics. Our base case is still that that's pretty unlikely given the interconnected nature of global supply chains, given the risks that would present to US households facing sticker shock at Walmart and Target. But with the steel and aluminum moves, with the exit of Gary Cohen, I think we have to start taking the possibility that Trump moves more aggressively on trade pretty seriously.
Does the U.S., Tom, does the U.S. run the risk of shooting itself in the foot by squeezing trade with China?
Yeah, absolutely. I mean, the reason why a trade war is not the base case is because, contrary to Donald Trump's claim that trade wars are good and easy to win, in fact, trade wars are bad and difficult to win. Think about the reality for U.S. companies. Companies like Apple, deeply embedded in global supply chains. Companies like Walmart and Target, deeply reliant on goods which they purchase from China. Think about U.S. households, many of whom voted for Donald Trump, who benefit from cheap made-in-China goods when they go shopping. Think about the Federal Reserve considering more rate hikes. Clearly, aggressive tariffs would push up U.S. inflation more aggressively and push the Fed into a more rapid tightening cycle. All of these things mean that our base case is still trade skirmish, yes, but trade war, probably not.
If I just flip this argument a bit, Tom, you know, the argument that China is definitely more closed than the others in world trade is, I suppose, is valid. How do you see Beijing reacting to what's going on, the statements from Trump and what the United States is trying to do?
Yeah, I think the tragedy for the U.S. administration is that the relatively limited steps that they're taking now to try and redress the trade balance are enabling the rest of the world to present the U.S. as a sort of a protectionist force. The reality, though, is that even with these incremental targeted tariffs from the Trump administration, the U.S. remains significantly more open to trade than China. China is one of the most closed-off major economies. Our view is that actually this reduces the chances of an all-out trade war because it means that there's scope for China to take some incremental steps towards opening to appease the U.S. administration and head off any further moves.
One final question, Tom, and you know, financial markets across the world and across asset classes have been a little nervous about this potential talk of this escalating to a global trade war. Is that a bit overdone? How would you characterize what's going on currently?
Yeah, I think it's overdone. I mean, clearly we can't discount the risks. Trump talks continually about protectionism. Now he's acted on that on steel and aluminum. Gary Cohen has exited, one of the main voices for free trade, for business-friendly policies, leaving the White House. The risks are elevated. At the same time, for all the reasons we've discussed, the cost to U.S. corporations that produce in China, the cost to U.S. households that buy made-in-China goods, The risk to the Federal Reserve, if tariffs start to push inflation higher, we think the base case is still a lot of noise, some targeted policies which are bad news for specific sectors, but nothing which approaches the level of a trade war that would start to hit the economic aggregates.
Tom Orlick, always a pleasure. Many thanks indeed for joining us with your perspective. Tom Orlick from Bloomberg Economics, talking about the implications of a potential trade war. Meanwhile, Indian Steel Association is worried that the steep import tariff in the United States will shift global trade towards other large consumers like India. In a statement released today, the steel body said the tariff will inevitably encourage steel surplus nations to divert their exports to vibrant consumption centers like India and distort domestic markets considerably. All right, but a trade war is likely to have implications for larger commodity markets as well, and it's not just restricted to steel and aluminum and other metals. To understand how this can impact oil prices, let's welcome in Vandana Hari, founder of Vanda Insights. She joins us on the phone line from Singapore. Vandana, thank you so much indeed for joining us. Is this on the mind of oil traders currently?
Good afternoon, Harsha. Thanks for having me on the show. It is very much an impacting and influencing factor in oil prices. But before I go into that, let's bear in mind that oil prices in general have been under pressure since the start of Feb. So the Feb second start of the turmoil in the financial markets. And the reason I hark back to that is that basically there has been a lot of nervousness in the financial markets with regards to accelerating inflation, a faster pace of increase in U.S. Fed interest rates. And basically the fears from that are that this could cause headwinds to the synchronous global economic growth that we have been seeing and we are expecting for 2018. Now, that has been, in turn, a major factor in the bullishness that we've seen in the oil prices. So oil prices have been quite smartly rising since pretty much the second half of last year. Now, of course, there are other factors there as well, but the global economic growth supporting good, strong global oil demand has been a major factor. Now, how the latest news on tariffs is playing into this is that, as your previous guest discussed as well, basically you have tariffs, tit for tat retaliation, and does that then lead to sort of a global trade war, which again slows down economic growth. So there's a lot of dots to connect here for the oil markets, but what happens is a bit of a knee-jerk reaction because, as I mentioned, there's already been a lot of nervousness. And when you start contemplating that, all of this put together could conceivably slow down economic growth, basically that doesn't bode well for oil demand.
If you look at the factors that influence oil prices, the dynamics of demand supply, how are that playing out? If I look at it from beginning of calendar year 2018, prices have been relatively around the above that $60 mark. So do you believe the demand supply situation is favorable for a rising oil market?
Yeah, so we saw Brent climb above $70 a barrel. It was the highest in 3 years, and that happened in January. But since then, prices have been softening quite a bit, and the financial markets anxiety turmoil, of course, dealt another blow to oil prices. But the base case scenario remains relatively bullish for the oil markets. I'm personally, and at Vanda Insights, we are constructive about oil prices, which is not to say they'll, above 70, certainly not 80, but 60 to 70 more on the upside, I would say, of that range. There's a lot of geopolitical tensions and real problems. Venezuela is one, and the upcoming tensions likely to accelerate between the U.S. and Iran with regards to the nuclear deal. I think all of that is likely to lend another upside to oil prices. So yes, I think overall I still remain constructive. I think it's a year where markets are rebalancing, so the fundamentals are supportive in the sense that oil inventories are draining. OPEC, non-OPEC producers are intent on complying and staying with their cuts till the end of the year. And oil demand growth is generally expected to be strong in line with economic growth.
One final question, Vandana. The United States has also been gaining ground as a dominant player as far as shale production is concerned. How do you see that playing out in the context of what Trump has said today? Do you see any correlation at all?
Sorry, I didn't get the first part of your question.
I said the dominance of the United States in the shale market. How do you see that influencing the current situation that we're talking about?
Yes, so that is without doubt here to stay. There's a lot of talk, especially with some OPEC members have been in Houston at a major oil conference this week, and they have, held discussions with their counterparts in shale. And, there's generally exchange of information, but that has raised a lot of speculation in the market that is OPEC trying to rope in the United States to try and, get them to rein in their production. Well, that's never, ever going to happen. The U.S. and the shale producers, they have lots and lots of independent companies. They completely follow their own economics, and they cannot be cartelized as such. So yes, U.S. production is set to grow to higher than Saudi Arabia's production this year. It may not grow by as much as 1.3 million barrels per day that the U.S. EIA is saying. I think it'll probably be a little bit less than that. But for the foreseeable the short term, next 3 to 5 years, U.S. is in a very strong position to continue growing its production without doubt.
Vandana, we leave it there. Thank you so much for joining us today. Vandana Hari from Vanda Insight, talking about what's going on in the oil market, the impact of a potential trade war on sentiment in the oil market. Meanwhile, back home, oil marketing companies have 3 factors working for them: rising marketing margins, stable refining margins, and higher oil prices, all of them that will lead to inventory gains. Sumit Sarkar has drawn up charts to tell us why the fourth quarter may turn out to be a good one for fuel retailers back home. Sumit.
Yes, they did remain flat in the last quarter of financial year 2018. As you can see in this chart clearly, how the gross marketing margin earned on sale of every liter of petrol and diesel by an oil marketing company was on a declining trend in the third quarter of financial year 2018. In fact, in the month of December, it was at its lowest point. But now, year to date, if you see, it has been on an increasing trend. It has increased in January, Feb, and in month of March, it is at its 9-month high. It is at around 3.6 rupees per litre and 3.3 rupees per litre, the level that we saw in July 2017. So what could be attributable to this rise in gross marketing margin is mainly the rise in retail fuel prices and the fall in Brent crude prices. And if you see in the fourth quarter of financial year 2018, the Brent crude has fallen by 2%, while our retail petrol and diesel prices have increased by 4% and 6%. Now this, compared to the last quarter, if you see, in the third quarter of financial year 2018, where Brent crude had increased by 16%, while your petrol and diesel prices are hardly moved in that quarter. So what is happening in the fourth quarter is the rise in retail prices and the fall in Brent crude is giving the oil marketing companies some room to increase their gross marketing margins and to make up for the losses that the company faced in the third quarter of financial year 2018. Now this rise in gross marketing margin will mostly help BPCL and HBCL because the contribution of the marketing to their total operational side is more. They contribute around 55% and 45% to their operational EBITDA. Now, though oil prices have come off a bit in this quarter, but on an average, Brent crude is still higher compared to the last quarter. Now, in the fourth quarter of financial year 2018, the Brent crude has averaged around $67.24 per barrel versus $61.4 per barrel in the last quarter. Now, if you see in the past, generally, whenever the Brent crude has averaged more compared to the last quarter, the oil marketing companies, that is IOCL, BPCL and HPCL, have reported an inventory gain. As you can see in the first quarter of financial year 2018, when it had fallen by around 7% compared to the last quarter, all the 3 oil marketing companies had reported an inventory loss of total of close to 6,200 crore rupees. In the following quarter, when the Brent crude increased to $52.1 per barrel, they reported an inventory gain of close to 2,500 crore rupees. And in the third quarter, where the crude prices averaged at $61.4 per barrel, all the 3 oil marketing companies reported an inventory gain of close to 9,400 crore rupees. Now in this quarter, the Brent crude has averaged at $67.24 per barrel, 9.5% higher compared to the last quarter. So we can expect an inventory gain to come in from these 3 oil marketing companies. Lastly, if you see the gross refining margin, it has remained stable at $6.9 per barrel. This is the Singapore gross refining margin compared to $7.2 per barrel reported in the last quarter of financial year 2018. Now, but if you see the month-wise data for the fourth quarter, it has been on an increasing trend. In January, it had came in at around $6.2. In Feb, it increased to $7.5. And so far in March, it is around $7.9 per barrel. So what this higher or increasing gross refining margin means? It means that the oil marketing companies can earn more by processing every barrel of crude. So these are the 3 factors that are currently currently working for the oil marketing companies in the fourth quarter of financial year 2018.
So, man, thanks for that. That's oil for you. Let's talk about gold. Gold imports are said to have slumped 31% in February. Imports fell to 67 metric ton last month from 96.5 in the same period last year. A person with knowledge of the provisional data from the finance ministry told us overseas purchases were valued at 14,820 crore in February as against 22,000 crore last year. All the rhetoric about an impending trade war is unlikely to derail the global growth story, at least not according to CRISIL. What it could impact is the pickup in global trade. In a conversation with us earlier today, D.K. Joshi, chief economist at CRISIL, spells out the 4 Rs that are crucial to India's growth story. Listen in.
These measures are, first, they have not been cast in stone. I think it's still work in progress, and I think it's not going to destabilize the global growth story, at least in the short run. I think what it's going to do is, I think over a period of time, is the trade was again picking up, and I think the trade intensity of global growth might go down as a result of these measures. But I think overall GDP growth for the world economy is likely to be in 2018 much higher than 2017. So we don't see it as a risk to global growth. Though I think it will eventually, it will have more implications for specific countries, let me put it this way.
Okay, now I just wanted to get that equation out of the way. Now let's, for the benefit of our viewers, tell them what is it that you're penciling in 2018 for the world, and as a result of that or otherwise, what's the kind of growth numbers or the nature of growth that you're pegging for India for 2018?
Well, I think for the world economy, we are assuming 3.9% GDP growth, which is the latest IMF forecast. And I think for India, we see the growth, the GDP growth at 7.5%. It is driven by the following factors. Number one, the recovery in global trade will also rub off on India. Because in 2017, we could not take advantage of the global growth because of domestic issues. The GST, particularly the issue of refund payments to the exporters, I think that got delayed, and as a result, I think exporters faced liquidity issues, and they could not take full advantage of the global recovery. So I think that scenario is improving. So the ability of trade to contribute a little more, I think, than last year, I think will be visible in 2018. So that's one factor. The number two factor is that, well, the base is very weak. I mean, so statistically the growth will look up. 6.6% is much below the trend rate of growth of India. So I think what we are saying is that from 6.6% it will go up to 7.5%. But I think on a sobering note, that even 7.5% is below the average of last 13 years, which is a little over 7.6%. So you're not even, I think you've not even touched the trend line as yet. And the other factors which will drive growth is the assumption of a normal monsoon, and the indications so far are that the monsoons will stay normal this year. The El Nino effect is likely to play out, which means good rains. So I think under these assumptions, growth picking up to 7.5% shouldn't be a surprise.
In the executive summary page of your report, Mr. Joshi, you've mentioned one key point about, and I want to understand from you the importance of this, resolving the NPAs through NCLT, especially from the steel sector, and the unintended consequences as well. We are in the midst of that resolution process. There are, of course, a bit of to's and fro's here, but in all probability, in a month and a half time, or maybe 2 months at best, we'll probably see some conclusion to this whole process. Has it been a good one, and does it bring the dormant capacities, if I can use that term, firmly back into the fray? And how critical is that?
Well, I think it will. Well, I think it's important because I think it gives confidence to the overall market participants that the resolution process is underway, and we believe that it will begin with the steel sector, and its steel sector is one of the largest contributor to NPAs, and the conditions for steel are improving. The domestic demand picking up, and the prices in steel also have gone up. I think that also bodes well. So I think this is the steel is probably the first case for for resolution. And once the biggies get sorted out, like steel, I think others will also follow. Now, that will actually will give a lot of confidence to the domestic players, as I mentioned, and it will also give confidence that the NCLT resolution process is proceeding. So far, I think we haven't seen any success, but I think the success, the indications are quite promising, I think, for resolution, particularly in the steel sector. And as far now, once the issues get resolved, the utilization of capacity, I think, will also improve in steel. I think so that's bound to happen. I mean, and what it means is that the need for investment in the steel sector will be less than, I think, will be lower than as in the base case.
Okay, that's a view from DK Joshi. Well, talking about NPAs, Reliance Communications has approached the Bombay High Court seeking to protect lenders' interests. This comes after an arbitration court barred the company from selling its assets to Reliance Jio. The company plans to use these funds it receives from the sale of spectrum, towers and the fiber business to repay its lenders. Bhuma Srivastava of Bloomberg News joins us with more details. Bhuma, explain, give us the context for this. What did the arbitration court say and where does this go from here?
So this dispute between Reliance Communications and one of the unsecured lenders, Ericsson India, that is before the arbitration court over unpaid dues. Now, since the arbitration court in Delhi hasn't taken a firm stand, hasn't finished looking into the lawsuit, it passed an interim order early this week restraining Arcom from selling its assets, which effectively puts a bit of uncertainty in the way of its deal with Dio. So we don't know if it will be finished, completed by end of March, as Arcom had initially predicted. So that's the new kind of uncertainty in the game. Arcom on its part has already moved to High Court and they're contesting the order of the arbitration court, and we'll just see how it goes from there.
So if the deal can't be done, they can't get the money and the assets can't be sold, they can't get the money, they can't repay.
Right, right.
Is that the...
Exactly. So the debt-bearing plans of Arcom, they kind of come under a cloud unless the deal can go through as planned. Okay.
Uma, thank you so much for that. The PNB fraud, meanwhile, may force the government to reevaluate its bank recapitalization plan. The 58,000 crore that the public sector lenders were supposed to raise from the market is now under threat, says a senior government official to Bloomberg Quint. Nikunj Ori sums up all those developments in this report.
The government may reevaluate its recapitalization framework for infusing capital in public sector banks for the next financial year due to the recent developments that have taken place in the public sector banking space, like the Nirav Modi scam and expectation of more public sector banks being brought under the prompt corrective action framework of the Reserve Bank of India, a senior official told Bloomberg Quint. Now remember, the government had announced that it would infuse about 2.1 lakh crore rupees in public sector banks in the current and the next financial year, out of which 1.2 lakh crore rupees would be infused in banks for the next financial year. Now, out of this 1.2 lakh crore rupees, public sector banks were expected to raise about 58,000 crore rupees from the market, and this would be difficult considering more banks are expected to be brought under the PCA framework of RBI. For the current financial year, things would stay as is, where the government has announced that it would infuse about 88,100 crore rupees in public sector banks through issuance of recapitalization bonds and through budgetary allocations.
All right, slip in a short break on that note. Coming up next, the government attempts to rein in the incidents of vandalism that started in Tripura and spread to Kolkata and Tamil Nadu. We'll tell you more about that in just a moment.
कुछ इसी तरह बच्चों के साथ साथ बढ़ते हैं LIC के चिल्ड्रंस प्लान्स, जो दे आकर्षक भुगतान बच्चों की हर बढ़ती अवस्था में। बढ़ो 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 मेरे संग।
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार, just working on my expansion plan.
Funding का चक्कर.
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. luck.
Are
This bridge gets you in touch with interested investors, funding happens, which means more outlets, more customers.
interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल.
हाँ.
NSE Emerge, साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
On 26 November 1949, the Constitution of India was adopted, recognizing liberty, equality, and fraternity as the principles of life, which cannot be separated from each other. The government of Karnataka has imbibed the ethos of the Constitution by developing programs and policies aimed at creating a socially, economically, and politically just society. Karnataka's flagship programs such as Maitri, Annabhagya, and Arivu have created an equal opportunity platform for all, irrespective of their gender, economic, or social status. Karnataka is committed to encourage education through various welfare initiatives, ensuring equal status for women and empowering minorities to uphold every individual's dignity. In the last 4 years, Karnataka has formed 462 new Gram Panchayats, which has taken the principles of democracy to the grassroots levels, and our Progressive Vision 2025 document engages public government participation to build a better state for all. Karnataka's collective vision to endorse fraternity, justice, and equality has transformed into Karnataka's model of development, which is based on the tenets of the Constitution.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Watching Power Lunch, this is Bloomberg Quint. I'm Harsha Subramaniam. The headlines at this hour. Global weakness hits Dalal Street as key indices slip over 0.5% each. Mid-caps take the biggest hit. Home Ministry issues advisory to state governments asking them to take all necessary steps to prevent incidents of vandalism. Talk of a possible trade war overshadows the big launches at the Geneva Auto Show. Quick check on how the markets are faring. The theme of the day has been the global weakness, particularly triggered by an impending trade war, thanks to President Trump's comments and tweets over the last couple of days. On the Nifty particularly, the nervousness is visible across the markets. The broader markets in particular are taking it on the chin. Bank stocks, the Bank Nifty particularly has been weak as well. Despite the clarifications coming in from the two lenders, Axis Bank and ICICI Bank, no such luck because Axis is still trading about a 1.5% lower in the red. ICICI Bank is lower 2.5%. Other banking stocks too have been trading in the red as well. The only pockets of the market that seems to be showing some signs of resilience are technology stocks, but the big ones, Tata Motors, Bajaj Auto, Bharti Infratel, BPCL, it's all a sea of red in the markets today. Mid-cap, as I mentioned, is also taking it quite significantly on the red at this point in time. But as you see it, about 168 points lower on the Sensex, the Nifty is down about 0.5%. Touching crucially those 200-day moving average levels technically, that would mean that this would be perhaps preparing for a free fall if those levels are broken. That's the market action for you. But meanwhile, market regulator SEBI has ordered Tata Motors to conduct an internal probe into the alleged leak of its financial earnings on the WhatsApp platform. This is the third company that SEBI is pulling up for an alleged leak. Sajit Mangat has the details.
As part of its ongoing probe with respect to WhatsApp leak, SEBI is looking at a clutch of nearly 12 companies, and we have already seen orders coming out against Axis Bank, SGFC Bank, and Tata Motors is the third company where SEBI has asked for an internal probe on the alleged leaks of financials for the third quarter of FY16. Remember, the results of FY16 third quarter were available on WhatsApp, and the results were very similar to what was leaked to the WhatsApp with respect to turnover, EBITDA, margin, profit before tax, profit after tax, and insurance claim. Something which is very intriguing for SEBI. SEBI hasn't pinpointed where the entire fault lies, but it has asked the Tata Motors management to bring in systems and processes and also clarify who are the people who will be in charge or who will be responsible for keeping the secrecy of these numbers till these are disclosed, approved by the board and disclosed to the stock exchanges. So this is the ongoing thing. What SEBI has asked them is to come out with a probe within, do the entire inquiry within 3 months, and within completion of the inquiry, the entire thing should be submitted to SEBI within 7 days. So this would be something which will be watched out for, and as we see, it's getting more and more murkier because while Axis Bank was related to 2017 and 16-17, SEBI has gone as far as December 2015 for Tata Motors. So it's going to be interesting to see which are the other companies where SEBI will come out with a similar order of asking for inquiry as well as some explanation from these companies.
Saji, thanks for that. The Union Home Ministry and the Prime Minister's office have condemned acts of vandalism that have been reported now from Tripura, Tamil Nadu and now West Bengal over the last couple of days. The Home Ministry has written to all states asking them to take all necessary action to ensure that such incidents do not occur again. It started first in Tripura when a Lenin statue was vandalized in Agartala just a day after the left government was voted out of power. Another incident has been reported from Vellore in Tamil Nadu where a Periyar statue had been destroyed. Today, students of Jadavpur University are said to have vandalized a statue of Shyama Prasad Mukherjee. The Congress party must shed its Gandhi tag and reinvent itself, says Assam Finance Minister and former Congress leader Himanta Biswa Sharma. Speaking to Bloomberg Queen's Tamanna, Sharma said that the 22 years that he spent in the Congress was a complete waste of time.
If you talk about Assam election, if you talk about 2014, that may have been one of my driving force, because I was humiliated and I was angry, and probably I have done at least I try to contribute more so far as Assam election is concerned. But in politics you don't carry all this kind of word, revenge and all these things. Now I am working as a BJP's ordinary worker. Whatever responsibility is entrusted to me by my party president, I am trying to do that. I think now that sense of revenge, sense of something, that is not there. I am just working whatever I have been asked to do.
Was it a challenge for you to switch over to the BJP in terms of ideology after being a member of the Congress party for 15 years? You were an MLA from the Congress for 15 years. The BJP stands for very different things. Was that a difficult decision for you?
First of all, I must acknowledge that in Assam, we have transformed Congress party during those 15 years into a different level. Because, as you know, we stantly opposed the Muslim communal agenda of Badruddin Ajmal while we were in Congress too. So, in Assam, even from very beginning, from 2001, we have followed a different principle than what national leadership used to follow. So yes, if you say that, I mean, in some way, because organization was new, structures was new, and I was not exposed to the kind of organizational structure BJP has. So initial 2-3 months, I think, yes, I do face few problems. But Amit Shah was so helpful, and Ram Madhav was so helpful, and both Amit Shah and Ram Madhav, I am really grateful to both of them. They have made my entry and made my my existence in BJP so easy that today, if I feel that I have wasted 15 years or I am in the Congress. I was in the Congress in 23 years. In hindsight, I feel that I have wasted 23 years of my life in Congress.
In your experience, what's the prime difference between the BJP and the Congress, and what do you see for the Congress's future? Yeah. It is still the largest opposition party, and even you would agree that every nation and every democracy needs a strong opposition as well.
The difference is very simple. I have been in Congress party for 23 years, but we are not allowed to enter Sonia Gandhi's residence beyond a point. But look at Mr. Amit Shah's residence. You can go, you can walk into, you can have food in his dining room, and you can walk into his drawing rooms, you can sit down in his garden, in his official quarter. Look at the humbleness. Amit Shah travel in Indigo, in a common, with a general passenger. And I mean, the difference is what? The BJP is a party which is rooted in Indian cultures, India's ethos, and BJP ministers, their family are like you and me. They are common people. But when it comes to Congress party, they behave as if Sonia Gandhi, Rahul Gandhi has come from a different planet.
Could you elaborate on that?
Yeah, I mean, they behave like a feudal lord. I mean, can you find out any chief minister of any Congress ruled state having dinner or lunch with Rahul Gandhi in his residence throughout his career? Because normally what happens, you invite your friends to your home, I go to your family. I mean, these are the Indian culture, Indian ethics. They always believe in master and servant relation. So I believe democracy needs an opposition, but that opposition should not be rooted on feudalism. That opposition should not be based on master and servant relationship. I mean, India is a mature democracy. A stronger, balanced opposition will evolve out of that Indian democracy. I think Congress has outlived, at least if not Congress, Gandhi family has outlived its utility.
What would your advice be to your erstwhile party, the Congress party, that of course now laying their bets on Karnataka next? What would you advise them today if you were not in any party but were just to guide them on what to do next?
I think my advice will be think beyond Gandhi's. I think India in 21st century, India's principal opposition party cannot be seen to be a family rule party. I mean, Congress has to democratize itself. Congress has to allow grassroots workers even to go up to the post of President of Indian National Congress. They must set their Gandhi tag. At 20 years ago, maybe Gandhi name would, there may have been some utility. But today, I think that tag has become burden for them. They must come back to define themselves as a normal political party, must allow upward growth to every individual, irrespective of their closeness to a family or not. Their people should be differentiated on the basis of their merit, and the aura of Gandhi should disappear, because there is no aura exists at all.
All right, let's move on from politics to the world of automobiles. New generation diesel technologies remain part of the solution to reducing emissions, even as the fuel has come into disrepute. So says Volkswagen CEO Matthias Müller. He said that in a chat with Matt Miller at Geneva Motor Show. Here's a slice of that conversation.
To my mind, this is a lot about communication, PR, and informing people. You are right. The diesel has lost in reputation, to a certain extent also caused by the diesel crisis that we are responsible for. But now the situation is different. The air quality problems in Germany have been around for many years, and the communities and politicians have not reacted to that deterioration in air quality. What we can do is we can provide technology, explain the technology of our modern diesels, market it, and make our contribution towards seeing the diesel in a renaissance. It's a part of a solution now, not part of a problem.
Some have suggested that if we start to see bans of dirty diesels in some cities, we should have a blue shield or some other kind of sign that shows you this is a clean diesel, this is a dirty diesel. What do you think about that idea in order to signify which diesels already have been improved and which haven't?
Yeah. The Volkswagen Group over the last months has contributed a lot to improving air quality and has been for many years, by the way. In the last 15 years, air quality in Germany has improved by 70%. Last year in Stuttgart has improved by 11%. We have 150 to 160,000 old diesels that we've taken off the roads over the last few months. And we've contributed to an investment fund to inner city mobility with 250 million euros. Foreign car makers have not contributed, by the way. 2.5 million diesel cars in Germany were updated with new software, and another million cars will be retrofitted. By the way, with cities and with towns and communities that face these problems, we are engaged in a dialogue to find solutions to fast improve the air quality in these cities.
Matt Miller also spoke with the CEO of Rolls-Royce, who stressed on the need for free trade relations across the world. He added that the US remains the biggest market for the automaker. The trade war, or the fears of the trade war, have become the overarching theme at the Geneva Motor Show this time.
The BMW Group is a major investor in the United States, not only when it comes to manufacturing facilities, but also for generating jobs. And I think brought lots of wealth into the United States economy. And for that reason, I think it would be very beneficial if we could keep these kind of open trade relations worldwide. And with that, I would love to leave it, because here it is Geneva, as you rightly said, and here we are for celebrating our Phantom in its 8th generation.
I have to say I have been to the South Carolina facility, BMW. They export $10 billion worth of cars a year from the U.S. to other countries. So clearly they're almost an American company, but Rolls-Royce is through and through an English company. You've got other issues to deal with, like Brexit. Does this kind of populist decentralization around the world concern you, or do your clientele simply buy what they want when they want it?
I mean, I always said, and I think that is true anyhow for quite a while, that Rolls-Royce is part of the British brand's crown jewels, if I may say so. And for that reason, Britishness is an inbuilt brand promise for Rolls-Royce Motor Cars. And the reason why we are so successful is also due to the part that we are fundamentally British, even me being a German as the CEO, if I may say so. And we want to stick to our guns, and we want to keep producing cars in West Sussex, in Goodwood, for very good reasons. So for that reason, I'm highly interested in free trade relations, also when it comes to Brexit or whatever, so that we not only have free flow of goods, but also, even more important for us, free flow of people, experts who are working in our facilities. And I'm still confident that we should see a proper, let's say, kind of agreement at the end of the day.
Let me ask about this new Phantom. You've got a pop-up store, or you had one on the Kurfürstendamm in Berlin. I spent probably a little too much time there. You do that also in Courchevel. You do that in Sardinia and other places, I guess, where the money is. How has this new Phantom been received?
Very well received, and I would love to quote some of your colleagues here, or I would even say many of your colleagues, who said, the best car in the world is back with Phantom 8, and I'm very glad that we've received these laurels. And rest assured, orders are flowing into Goodwood, and the order book is very strong. And if you would order today, Matt, probably you might be lucky to take delivery before Christmas.
Well, I just sold my house, so I may be able to not buy a new house, but a new car. The order book is filling up. Where are those orders coming from, mostly regionally in the world?
I mean, the United States still is our biggest market worldwide, and I'm not surprised seeing that to happen also over the next couple of years. China, very important for us. The Middle East, strong market, but also the European market is going from strength to strength. UK, our home market, always stands for around 10% of the volume. So you can say basically we are a global player and volumes are coming from all over the world. Japan, for instance, a very fundamentally important market for us. South Korea developed nicely over the last years. So I'm happy that we have eggs in many, many baskets worldwide.